In this trading course, I'm going to teach you everything you need to know about one of the best concepts in trading, supply and demand. By the end of this video, you'll fully understand the theory of supply and demand and how to apply it to find great trades. But first of all, what is supply and demand? Supply and demand is the core force that drives our markets. And we're looking at a price chart here. And when demand increases, this line here representing demand, we see an increase in the price of an asset. Let's use gold as an example. As demand for gold rises, the price also rises. This happens because available supply of gold ready to be traded in the market decreases as demand grows. Now, why does this happen? Why does supply fall as demand rises? It's simple. When a large number of people are trying to buy an asset, meaning demand is high, those buyers are taking units of that asset out of the market. The more people buy, the more existing supply is absorbed and less supply remains available. Lower supply creates higher scarcity, and higher scarcity naturally drives the price up. And if something becomes rare, its value increases. And that's simply how markets work. Now, if demand starts to slow down, meaning fewer people want to buy and instead begin to sell, the market experiences the opposite effect. People selling their assets return supply back into the market, increasing the amount available. And when supply increases, scarcity falls. With less scarcity and more units available, price generally decreases. So to summarize, when demand increases, more people buy. Supply decreases, scarcity rises, and price increases. When demand decreases, more people sell. Supply increases, scarcity falls, and price increases. And of course, lower demand simply means fewer people want to buy the asset in the first place. To apply supply and demand concepts directly to our trading and technical analysis, we use what are known as zones. These highlighted areas on a chart represent supply zones and demand zones. A demand zone is an area in the market that forms before a large upward movement. Typically, this begins with a period of sideways or consolidating price action, sometimes just a single candle, followed by a strong push upward. This entire region becomes our demand zone. Similarly, when we see a sideways price movement, again, maybe one candle or several, preceding a significant drop, this forms our supply zone. The underlying theory for why these zones matter is rooted in buying and selling pressure. For a market to pause, consolidate, and recoil before a major push upward, it tells us that this region, where price slowed and moved sideways, is where large buying orders were placed. That buying orders absorbed available supply, creating demand, pushing price higher. The price appreciates due to increased demand and decreased supply. In the opposite case, so supply example, the consolidation before a strong upward move signals that new supply has entered the market. Demand decreased at the same time. More assets become available for sale and available to trade. And therefore, with excessive supply and lower demand, price pushes downward. So these zones mark points where significant buying or selling interest previously entered the market. Now, the way we actually trade these then is to buy from demand zones or sell from supply zones when the market returns to them. Because the demand zone is an area where strong buying once occurred, it represents what we could call a discount price. Traders previously viewed this zone as an excellent buying opportunity. They stepped in aggressively and the market rallied. If the market later rises and then begins to slow down near higher prices, that indicates the price at the top is no longer attractive or discounted for buyers. However, we already have solid confirmation that the demand zone below was considered a good price to buy. Therefore, if the market drops back to that zone, it is very likely that a new wave of buying will occur because it is once again seen as discount. The same principle applies to supply zones, except these represent premium price levels. So an ideal place to sell, if you previously held a buy trade, selling here secures maximum profit. If you intend to enter a short position, this is where you would get the best entry, offering the largest potential downside move. Selling lower on the chart offers much less profit potential. Selling from a premium level, however, allows you to capture the full downward move that follows. Thus, when the market returns to a known supply zone where sellers have already proven they are active, it becomes a high probability location to enter a short position and profit from the move down. Now that you understand supply and demand zones, let's take a look at real chart examples and put these concepts into practice. So here we have a market that is in a downtrend. We're going to identify a supply zone and show you what it looks like in the real markets. So we can see we have this big push to the downside. This candle is an area of consolidation. Now, how do we indicate an area of consolidation or indecision? Generally, when we are plotting supply and demand, the simple rule is to use an indecision candle. And I like to use the last candle before the impulse. So what this means is I don't care what color the candle is, but I want to see the last candle before an impulsive move away. So if we take a look at this one here, and we take a look at this one here, these are indecision candles. They're indicated as indecision by the fact that they have very large wicks and very small candle bodies. Wicks show rejected prices. So what we're seeing here with these wicks is attempts to go higher and attempts to go lower. And what we see with the small candle body is pretty much failure to get far in one direction either way. We didn't get a high, we didn't get a low in this given period of price action. So this creates an indecision candle. Now we're looking for the last indecision candle before an impulsive move. An impulsive move is a strong bearish or bullish candle, or a series of strong bearish and bullish candles. So you can see the candle I've just marked here. This is an impulsive candle. It's a large sell candle with no resistance from the buyers. We see as well this one, after this indecision candle, is a large selling candle with clear strength from sellers and no resistance from buyers. So that is how we're going to be plotting these in real time. We want to see the last indecision candle before the impulse. The last candle before the impulse is the rule I use. Now, if you've learned supply and demand anywhere else before, you might have the last down candle before the up move, or the last up candle before the down move as a rule. I don't use that. I use the last candle before the impulse. The reason I do this is because it is this candle here where the selling pressure has accumulated. It's not the last up candle where the selling pressure came in. This was a strong bullish candle. It's here. It's the very last candle before the impulsive move. It's exactly where the momentum has built up to create a selling move. It's the selling pressure. So that is the rule. Last candle before the impulse is going to be the one that we use for supply zones. So now to show you this example, we're going to focus in on this one. We're going to talk a little bit more about differentiating zones a bit later, but for now we've got our supply zone. To mark a supply zone, we find the last candle before the impulse, and we want to mark the high to the low. That includes the wicks. So our supply zone will be this. We've just gone from the high to the low of this candle. What we would then expect is for the market to return to this level and then sell off from here, because we know that's where the selling pressure has been previously. We know this is a premium price to sell from, so we would expect that to take place once again, and this is going to be our supply zone. We're going to mark that with the SZ. Why is it supply? Because it's in a downtrend. It's a selling move. Demand is when we pull back to a buying zone. Supply is when we pull back to a selling zone. And so this is a supply zone. So what we could generally expect to see from there, then having plotted that correctly, would be for the market to return to here. We would then look to sell there, and then we would profit from a new low being formed as the market falls. So just as a very simple trade example, we would have our entry here, stop loss above the high, and our target down at the lows. We're going to get more into all of this stuff soon, but first brief example. So there we go. We see the market push into the supply zone, and what actually happens here when the supply zone is hit is a new wave of selling pressure comes in because of the discount price level, because that premium price has been hit. Sellers that sold here before are more than happy to sell here again. And you get this nice positive movement straight down to your target, which is of course how we want to make profits from supply and demand. Now, one very important thing about supply and demand is that you have to use it in a line with the overall trend direction. So we can see that this market is falling. It's creating lower lows and lower highs, meaning every low is lower than the previous one, and every high is lower than the previous one as well. So what this tells us is that the market is in what we call a downtrend. And in a downtrend, we only want to focus on selling supply zones. We do not buy demand zones. If we take a look at this market, we have multiple areas we could potentially see as demand zones. But if we were to buy these every time the market came into them, we would be destroyed. All of these areas would classify as demand zones. But if you were buying here on the way down, you're buying here, you're buying here, you're going to get destroyed and lose loads of trades. So the kind of sneaky thing about supply and demand is that supply and demand zones visibly appear everywhere, but you need to trade them in context. So in a market that is moving down, we only want to sell from supply zones. We do not want to focus on demand zones. Now I'm going to give you a very quick class on market structure to explain it. So through this phase of price action just here, we can see the market is creating higher highs and higher lows. So a higher high is very simply just a high like this one that's been printed in the market, and that's higher than the previous one. Higher lows, again, is just a low that's higher than the previous one. So as the market is creating higher highs and higher lows, that puts us in an uptrend. And that means the only thing we should focus on doing here is buying demand zones. We should not sell supply here. So this is an uptrend. We want to buy demand, and that is how we trade when the market is forming higher highs and higher lows. At this point, we see the market shift, and it actually breaks into what we call a lower low. How do we get this? Well, simply this low is lower than the previous low. Therefore, it's a lower low. And through any phase of price action where we can clearly define the market, it's creating lower lows as well as lower highs. We want to be selling supply. So if the lows start to form lower than the previous ones, and if the highs start to form lower than the previous ones, this puts us in a downtrend. And during a downtrend, we want to pretty much ignore demand zones, and in here we want to sell supply zones. Now, if you really want to go further in depth on market structure, lucky for you, I have a full masterclass on that as well. Click in the top right and that will take you to it. So here we have a market that is creating lower lows and lower highs. Therefore, what do we want to do? We want to sell from supply zones. Now I'm going to use the sideways candle, this pullback candle, this kind of indecision candle in this downward move as supply. And as we can see in this example, there's a little wick here that extends further on the next candle. So I would actually use this green candle to mark my range, but then I will extend the high of the zone to the wick that's being created by the next following candle. So we use the high there down to the low here, that creates our supply zone. So the idea is then we're going to sell into supply because the market is currently downtrending, creating lower lows and new lower highs consistently. So that will be pretty much where we get into a trade from that point onwards. And as we see the market coming down, of course, we could then just continue selling supply zones. So we see here again an indecision candle. So we would mark that with a supply zone. That will be another opportunity to sell. Stop loss there and take profit lower down. So that's the general idea as to how we focus on a downtrending phase of price action. Now, as we can see coming in from this point, we're starting to push to the upside. Taking a look at structure, we actually pushed over this high. So we have a high, lower low, lower high, lower low, lower high, lower low. Then the market's pushed up, and now it's created a higher high. So this actually puts us into an uptrend. Meaning, what do we want to do in uptrends? We want to buy from demand. So here's our indecision candle, our sideways candle before the impulse. The last candle before the impulse is what I use for my zones. So we can mark a demand zone here. And what we want to do at this point is buy from demand, meaning any supply zones that form will be ignored. You can see that demand zones did form in this move up, but we ignored them and focused on selling supply because the market was down. Now that we've shifted up, we want to focus on buying demand and we want to ignore supply because the market direction is up and we're moving with the market direction using supply and demand to make our executions. So in one moment, you will see the market returns to this area of demand. and then we get a tap in and a push away into new highs. So that is how we use supply and demand in line with the trend, with the real example there of a downtrend selling supply and an uptrend buying demand. So in order to validate a supply or demand zone, we need to make sure there's something called an imbalance. If there's no imbalance into a zone, then it's not a zone that we want to look at. And if you take a look at where I'm drawing these white lines, we can see just above, so this candle here, this green candle, this is going to be our supply zone. It's the last candle before the impulsive move down. Now we can see there's a gap between the bottom of this green candle and the top of this wick here. This is an imbalance. An imbalance is an open price range. It's this area here. Basically, what it is an area that hasn't been filled with wicks yet. If this candle had pushed up and hit this area, then this would have created what we call an efficiency and removed any imbalance into the zone. But because we still have this open price range here, that means that there is an imbalance into the supply zone. So this would be a good supply zone to sell from. And we would expect when the market comes back to it, we could happily sell from this point because that would fill the imbalance and the market would likely move lower. Now you have to have an imbalance to your supply or demand zone, otherwise it's not really valid. So if you take a look above, we've got this indecision candle here. This is the last candle before the impulsive move to the downside. And just to clean it up, let's get rid of this and this. But the problem with this zone is that there is no imbalance into it anymore. So here we have our supply zone. We have a push away. The market's pulled back, filled in the imbalance, and then pushed down. So initially, if you were looking at this supply zone and you wanted to sell it here, that would have been okay. But now that this has already been filled and there's no imbalance, this would not be a good supply zone to try and sell the market from for two reasons. Number one, the market probably isn't going to get there because it's probably going to react to the area with the imbalance. Number two, if it does get there, because the imbalance here has already been filled, there's a high likelihood of pushing higher, which means it's a low probability and probably isn't going to give you a good trade. So we need to trade from supply and demand zones that still have imbalances. And if we look at this leg of price movement, there's no imbalances up here. There's no open price ranges. Every wick is touching the previous wicks. So we have this push down, and this wick is touching this wick here. But then we have a push down, and we have a gap, where this wick here is not meeting this wick here. So this is basically going to create our imbalance, making this a high probability zone to sell from. And to show you that in action, that's the kind of movement we would expect: a fill of the imbalance and a push to the downside. And a rule that goes alongside that is, of course, that a zone is only really good on its first tap in. So in this supply zone above here, we had a first tap in at this point. So we created a supply here, had a push down, pulled back, and then sold off. However, if the market was going to come back to this supply zone again, we wouldn't want to trust that for a trade because it's already been hit. And basically what we're looking for is for this supply zone to absorb all the new sell orders and drive lower, like we're currently experiencing in price right now. And we can see we have the supply zone, the market is pulled back, filled in the imbalance, and as soon as we hit supply, we absorb all the sell orders, so new sell orders that come into the market, and we go and make a new low, which means this supply zone is pretty much redundant now. Now the actions we would then want to take would be to start looking at the next imbalance supply, for example, this one here. But if the market was to return to that supply zone again, so if we came up here, we definitely wouldn't want to look for another sell, because the more times the supply zone is hit, even if it doesn't break on the first time, the more likely it's going to break through and actually go the other way. Let's take a look at what happens next. So we can see that if the market comes up to this supply zone, we don't want to sell there again, because it's a high likelihood that the market is going to go straight through it, especially as we've already tapped it. So although this supply zone has been prepped up, we had the first trade here, which would have been a great trade, but then a second tap. We don't want to sell here. This is not likely to get into new lows. And as you can see, we didn't do that. Then we have a third tap. We don't want to sell there. Fourth tap, we don't want to sell there. And then on the fifth tap, it actually breaks through. So supply zone is only really good for its first retest. Right after that, ignore it. And the same goes for demand. If we're in a buying example, of course, we only want to use the first tap of a demand zone. Then we move on to other zones to validate next trades, because the more times the demand zone is remet, essentially it's showing us that the buying pressure is not strong enough anymore, and showing that sellers are really attempting to push price lower, and eventually they will likely win. So crucial tips to remember when trading supply and demand. Always trade it in a line with the trend. Only trade imbalance zones. So any zones that aren't imbalanced are not worth trading. And only trade the first tap of a zone. If a zone has been hit 3, 4, 5 times, do not trade it. It will likely break. Now that we've covered all of that, I want to talk about different zones. So we're going to talk about extreme zones, first of all, and then how to approach multiple zones. So this market is downtrending, and we have a break of structure here. The market has created a new lower low at this price point. So say we want to sell this, how are we going to select which zone to sell from? First, we can follow the rule of imbalance. We say we want to see imbalances into a supply. Otherwise, there's no reason to take a trade from that point. If we take a look anywhere pretty much from the top of the movement down to here, we can see that there's no remaining imbalance zones inside of this price movement. So every single one of these zones here has been retested by a wick. There is no candle where the wicks to wicks are not meeting each other. Therefore, there is no imbalance. Now, there was some imbalance created here, but we can see that the market filled that range and retested just here. So all imbalance before this point is filled. There's no imbalance ahead of this level. That is going to lead us to look at this area just here. And in here, there are two areas that we could look at as our trade entry to sell. The first is this one at the top, this indecision candle before this impulsive move down. This is what we call the extreme zone. Now, an extreme zone is simply the furthest zone from price in the existing leg of movement. So if there was an imbalanced zone up here, being within this leg of movement from the top down to the bottom, the extreme zone would be whichever the furthest one from where price currently is, up here. However, there isn't any imbalanced areas up here. So the furthest zone from price inside of this existing leg of price action, from this point we're at now, is going to be the one we've drawn the yellow arrow to, because this is the final imbalanced zone. Therefore, if the market gets past this, we can expect, because there's no real supply anywhere in here, that the market has a pretty good likelihood of actually moving into new highs. So if we're looking for a high probability place to sell from, we can do that from just here. Now, there is of course a level just beneath as well. It's going to be this little bit of indecision before the continued sell-off. Now, it's not really the greatest supply zone. And what we still have here is imbalance above, which is pretty clear, which leads us through to a pretty significant point, being that extreme zone on top. So in an example like this, we would definitely want to focus on this zone over this zone. However, that's not to say that we have to completely write off any possibility of finding a position from this lower zone. We could still maybe see the market flip. So what we can do inside any of these zones when we have a situation where there are multiple zones is we can use what we call a standard confirmation or confirmation entry. That's going to be a pattern like what you see here, which is basically where we're looking for a low time frame conformational shift. And then if the market goes from creating higher highs and higher lows inside of this existing trend, for example, where we start here, create a high, higher low, higher high, and if we trend up like this, and then we had a shift in the higher high and higher low structure into a lower low here, then we would use fractal supply zones to sell again. Then we could use this area here, a supply zone inside of the smaller price action here, to actually get an execution to take the market lower down. So if we approach it this way, basically if the market confirms a reversal in here, we get a trade. If it doesn't confirm a reversal, so if the market just comes straight up and goes straight through, because we waited on that confirmation, we actually don't take a loss. We just don't take any trade at all because it hasn't been confirmed. So the extreme zone is the highest probability point to sell from or buy from when it comes to supply or demand. We would be happy in this instance to then place a sell order in terms of a sell limit at this level. If you're going to be placing sell limits and buy limits, the best place to do that is at extreme zones. And if you're going to be approaching the market with confirmation, or you're approaching a market that has multiple potential zones, then you're going to want to use confirmation on pretty much all of them except the extreme zone. Now, when we see the market come up into this area, we do, however, get a confirmation entry. And I want to walk you through it now so you can see what it looks like in the real markets. So we're going to remove that for now, the hypothetical sell idea, and we'll take a look at this structure that we have right here. We've hit the supply zone just there, which gives us what we want to see, to have the confidence and clarity to start selling. Now, the confirmation entry is actually arisen inside of this price action. So if we mark the low to the high to the low, this is going to be a trending structure right now. We then have basically smaller trending price action like that. This is the kind of trend that we have. By marking the highs and the lows of this bullish movement, we're then basically looking for this to shift bearish to provide us confirmation to sell into this market. Now, as we can see, our swing lows or our higher lows are going to be pretty much this point here. And then a more significant one will be this one here. Now, we can see with this bearish candle, we've had a closure below both these lows. So what this actually does is allow us to sell into this, because we're seeing with the formation of this lower low that we've got just here, we're seeing the market shifting to bearish, so a selling setting. We're seeing it shift to a downtrend, which agrees with the high time frame narrative, of course, that this is a bearish trend idea. So what we do here by bringing this in is actually to use the big picture and then a more refined, smaller picture to build a scenario in the market where the high and the low timeframes are in complete agreement. When we have that, we can sell with confidence, because now we know the high time frame is telling us that the market is bearish, and the low time frame is also now agreed and told us the market is bearish. We actually use supply and demand here in a fractal nature. So fractal essentially means the same patterns will form on all different time frames. They will form in all different scenarios, regardless of whether you're looking at the daily, the weekly, or whether you're looking at the high time frame, zoomed up price action, or the more refined, zoomed in price action. It's all going to work the same. So the big picture trend, which is going to be this one that we're looking at here, is bearish, and we have a supply zone that we want to sell from. Now the smaller picture trend, which is going to be this one, has now shifted bearish, providing us with a supply zone to sell from. Now the supply zone in question here is this last indecision candle before this impulse away. This means we can therefore place our sell limit on this area, target down into the lows, or wherever we want this to go. And for this, we don't have to put the stop loss over this swing high, because we have new confirmations inside of this structure. So we can actually place the stop loss over this high, and that's going to provide a very safe trade as well. But this time we've had that kind of double confirmation. We've had that shift confirmation here. We've sold on retest, and now we'd be looking for the market to roll over and make a new low. Given that it's reacted from supply once, and then reacted from the second supply, providing two supply reactions. And as you can see, that's exactly what happens. So in a general market scenario, you want to focus primarily on the extreme zone, which is going to be the last imbalanced candle in this leg of price action. For this scenario, it's this one here. If there are other zones to focus on, such as this one here, then the best way to approach these, if you want to focus on these zones at all, is to go in with a standard confirmation, which, as you've just seen, is actually what we've got going on here. This pattern of shifting from higher highs and higher lows into a lower low, and then pulling back and selling from supply, can be utilized not only from extreme zones, but from within these smaller zones as well. If you see this pattern formulating in one of the other zones in a scenario where there are multiple supply zones to choose from, then that can give you the confirmation you want in order to get into a trade that is likely to win. But if there is no confirmation, such as there wasn't any in this zone, then you simply avoid taking the trade, meaning in most cases you're going to avoid taking a loss. And you can take your trades comfortably from the extreme zone, or if you really want, you can use the confirmation from there anyway. And that a lot of the times is going to provide you with a good entry to get in. But I just want to give you a warning. Confirmation entries, whilst they are very strong, are not going to happen all of the time. If you take a look at price action back here, at this point our extreme zone was this candle here, this indecision candle. We had a big push to the downside. We have no imbalances above. We have no other zones left open. So our extreme zone is the one we're looking at here. If you were going to wait for a confirmation from the zone, you would then want to see the market pull in and make a shift in structure like this. that would allow you to get into a trade. However, as you can see, there was no confirmation given. In fact, the confirmation for this trade is actually going to be when the market returns all the way to this supply. But this is going to mean you're not going to profit on this entire move down. You're going to have to wait for the pullback to get it. So essentially, that becomes a missed opportunity. So you can avoid that from happening if you focus on extreme zones. As I say, sell and buy limits most of the time are going to be good from these. It's not always going to work. Sometimes the market will flip on you, but the risk reward you can get from these, if you sold this extreme zone, stop loss above, target down into, wherever you wanted to go, you could potentially get 5, 6, 7% trades coming in here, which means even if you only won half of the time, you're making significant profit overall due to the fact that every time you're risking $100, you're making $700 in return. So they stack up from a risk reward perspective. But that confirmation entry is a really solid way to, number one, double confirm trades if you really feel like you need it. So, getting in from around this point after the market confirmation has occurred. And number two, you can use this if you're not trading from the extreme zone, if you're looking at a more refined zone as well. So that is how you differentiate between multiple zones. The extreme zone is always the highest probability, the highest reward, the most favorable zone to buy or sell from. But if there are other areas that you might want to look at, just go at it with that confirmation perspective. As long as you wait for that, you're going to have the confirmation, you'll have the confidence and the clarity to get into that trade. Now, just to quickly show you what that looks like from a bullish perspective, we would instead have a demand zone here. Demand zone is retested, market pushes up. We get a bullish break of structure this time. So the market pushes over these lower highs and then pulls back. We want to utilize the demand zone, the last candle before the impulse that broke structure. That's where we're going to get into a trade. You can then trade that up to the next highs or beyond if you want to. That is a breakdown of extreme zones, confirmation entries, and how to approach supply and demand zones in real markets where things aren't as clean as theory talk. Now, something really cool about supply and demand is that this is a fractal theory. Fractal means that the concept works on pretty much any time frame you want to look at. Whether you want to look at the weekly, the daily, the 4, the 5 minute, the 1 minute, it's all the same. So let's take a look at some examples. I bet you couldn't guess what time frame these 3 different examples are from. Now obviously, they all look very similar. The market follows price action regardless. These are the hourly, the 4-hour, and the 1 minute time frame. And I do that to show you that really, you are never going to guess what time frame a supply or demand zone is formed on just by looking at it. Which is a great thing, because it means whether you're day trading, scalping, swing trading, positional trading, these concepts will work regardless of the time frame. So don't worry, you don't have to use a specific time frame to use supply and demand. You can use it anywhere. So one big thing that you should bring into your trading is top-down analysis, which is pretty much the idea of using multiple different time frames to work out where the market is going to go. You go from the top down on the weekly and the daily to build narratives, and you go down to the lower time frames and actually find setups. Supply and demand can be used in this context, and it can be used for 2 things. First of all, it can be used to identify target areas. Second of all, it can be used to identify where trades are likely to take place from and lead into. So we're taking a look at an example here on EuroCAD. We're on the weekly time frame, and as I've shown you with fractals, it doesn't really matter what time frames you're working on, but this is a breakdown as to how you can take advantage of the targets and entries and building narratives on the high time frames using supply and demand. Here on the weekly, I've just marked out a supply zone and I've marked out a demand zone. Because the weekly time frame moves so slowly and it covers so much ground, we're not really looking for massive movements on time frames like this. What we're looking for is generally defined areas the market could lead into as targets and as trade entries. So if we build this picture, supply and demand, we've now got a clear range, as maybe the market could go up to here, and if it did, and we got confirmation, we could sell down to here. Or maybe the market could go down to here, and if it did, we would then look for an opportunity to buy up to here. And these weekly ranges are actually pretty big. So if we were to look for a sell from here down to here, we're looking at over 130 pips. That's a pretty big range that you can trade through. That will give you some very big trades. And then the run from this zone to this zone is actually 400 pips, which again is a very big range. that you can find one very large or multiple smaller trades within. Now, if we then run this market forward, obviously it's the lower time frames where you will actually be doing the analysis, but you're going to see that we actually do build narratives and ideas here. Because number one, clear imbalanced demand. Well, if the market is showing weakness down to this level, selling here would be a good trade to look for. So that's going to be a position that you could profit from. Number two, when the zone is filled, we know the next likely move for it to make is probably going to be a drive to the upside. So you can start looking for buying opportunities from there, given low time frame confirmations. Now let's say we get into the point that we are right now. We've had a break of structure where the markets came and created a higher high. We have our standard confirmation pattern looking like this. And now we would say we're looking for a long position. So what do? Well, on the weekly, we would identify an area of demand, like so. And then on the lower time frames, because we now have this high time frame narrative of pulling back to here and buying, we could look for opportunities to sell from where we are throughout the week, using lower time frames like daily and 4-hour. And then when we meet this area, we could start looking for opportunities to buy. So if you build your high time frame narratives, all you literally need to do is use very simple ranges and very simple supply and demand. And as you can see by how this market is forming right now, it's going to fit into your analysis and give you some very good trading opportunities. Number one, in the form of sells down into demand zones, or buys up into supply zones, as we saw here. But number two, once these ranges are filled, and once these demand zones and supply zones are hit, well, then you've got clear entry opportunities, because you understand the probability is that the zone will hold and will likely lead through towards the next area with the next movement in price action. Weekly timeframes and daily timeframes for building narratives with supply and demand. Very strong stuff, super simple, and very effective as well. You can start a trade range to range using supply and demand format. It really simplifies your high time frame analysis and gives you biases to work with inside of each week. So to lead on and elaborate on one of the concepts we just discussed, this is the idea of using supply and demand, not only for entries, but also for targets. We've gone to a completely polarizing opportunity. We're looking at the 2-minute time frame to highlight that supply and demand works the same on every single time frame that you look at. Okay, for a setup like this, the opposing move is basically going to be this push down. Or in the real example, we're looking inside of here to find areas of supply. Let's take a look from the low then. Well, we have this one, but this has already been hit, so it's efficient. There's no reason to look for this one anymore. As we know, when the market hits a supply zone or demand zone more than once, it essentially becomes useless. Which is also good news, by the way, for forecasting the strength of this trade. Because the fact that we've gotten back into the supply zone again and traded higher than we did previously and closed higher than we even did when we formed the supply zone, this tells us this is a strong move. So they can actually be used multiple retests on supply and demand zones to indicate the strength against a zone, which allows us to get more clarity for trades like this one. But obviously that then is going to write off this supply. Well, then there is no imbalanced supply zone here. There's a supply zone here, but it was filled by this wick. And then there is an imbalanced supply here, this indecision candle before this impulse down. So we're going to follow the same rule. We're going to mark out the low to the high of that supply zone. And what we're going to do, as we've done in these previous examples, and as I've showed you, we're going to cover the high of the wick of the next candle as well. So that's our supply zone. So in terms of entry, it would be this demand zone here. So the last candle here before this impulsive move up, and stop loss below the lows. So now, yes, we could target the overall high, but if the market wanted to slow down inside of this supply, or if we wanted the simplest and most high probability trade that we could get, well, then we could go with this supply zone as our target, which would be a 1-to-5 risk-reward ratio. The idea then being, if we get our fill, if the market's going to reverse, it is very highly likely at this point to at least get to this supply zone before it reverses. And of course, a supply zone is the highest probable point for a reversal to take place, because this is an indication that the sellers stepped in here before. So there is this kind of forecasted potential that sellers could step in here again. And when they do that, what happens? The market goes down. So if we want the cleanest possible trades, we can actually use supply and demand to identify the highest probable points to get in, but also the highest probable points for sellers to step in against our trade, or for reversals to take place. And then if we simply trade within that range from demand to supply, as we are here, there is no imbalance supply anywhere here. There is here. So there is a very high likelihood of us getting to this point. But there's also a reasonable likelihood that this is where the market reverses. So by understanding this, we can have a clean trading range. We can be in a demand, extreme zone, no imbalances left beneath, high probability entry, and we can be out at supply, extreme zone, high probability reversal, and high probability exit. No imbalances beneath this, which creates a very high probability range for us to push through. Now I'm going to run this. You're going to see what happens when the supply is hit. We get a small push through, good sign to begin with, but then we have this pretty dramatic sell-off. Now obviously, in some cases, the market is going to drill straight through these zones and take you up towards your targets. But in some of these cases, we're going to get these selling movements, and this can lead us back into new bearish moves. So if you target from demand to supply, or from supply to demand, you're basically setting yourself up with the most simplified positions that you could possibly take, and you avoid getting killed when the market does stuff like this, reverses on your trades after getting very close to your target. You know, if you held this trade all the way up to here, well, you're going to miss out on this entire move now, because it's all the way back down to your entry. But if you just focused on demand to supply trading, number one, it's very simple. It's very easy. Number two, you're going to be out of these trades because the market is highly likely to trade from range to range. It's only when new ranges are met that significant reversals can take place, making this the most simple way to use supply and demand as targets and entries. So that's pretty much everything you need to know about supply and demand. Now, if you want to get results like these fast, click the link in the description below for your free strategy call now. I help busy professionals and entrepreneurs achieve consistent trading results in just 4 to 8 hours a week using my proven market to edge system. Thank you for watching.